Stock after being falsely attacked by a video suggesting that LiDAR is superior to Tesla's FSD technology, which we all know that it's not, and the subsequent price target reduction and delivery target reductions from Mizuho caused Tesla's stock to have a bad day today relative to the rest of the markets. The rest of the markets actually did pretty damn well. S&P had a great day today following Friday's 2% rise, up another 1% today. But the real test comes over the next couple of days as we get the Fed meeting, more real estate data, and even tomorrow's catalyst, which is the GTC conference via NVIDIA. This is all about AI and applications for GPU technology. Well, AI being a critical function of this market and the bull thesis to be long stocks right now, this comes at a critical moment. Especially considering your biggest stocks in our markets, NVIDIA, Tesla, Microsoft, Google, Meta, Amazon, Apple, a lot of their main narratives right now for the future is around AI. So anything good or bad at that conference tomorrow is going to be very important. This GTC conference started today and is going through March 21st. But tomorrow at 1 p.m. Eastern Standard Time, the keynote speaker will be Jensen Huang, NVIDIA's CEO. And if he has good things or negative things to say, I doubt it's going to be negative. I'm sure there's going to be a lot of positives there. Then that's going to impact markets and some of your biggest AI stocks. Now, with that said, I do think there is reason to be optimistic if you are a Tesla stock investor, although I remain quite conservative on my views of the broader markets. UBS today is coming out with a new note suggesting that the correction is over. But ultimately, whether or not the correction is over comes down to what happens with the economy. As much as we place the blame on this correction from tariffs, and I do think tariffs have been a large drag on markets, it really just comes down to, do we go into a recession this year? Do EPS targets meet expectations? Do they come in below? Do they come in better? And how is the overall economy? If the economy and earnings get weaker, well, that's it. The markets are going to fall. Okay, and we have not priced that in. If things are maybe, sentiment-wise worse than reality, then maybe we recover from here. But I still don't like the risk-reward. If we go into a recession, stocks could fall 40% from here. If we do not have a recession, but have slower growth, lower earnings, then your upside looks like new all-time highs, which is 10, 12% or so higher from here. I don't like that skew towards the downside risk. But UBS does come out with this positive note today. They say the S&P 500 likely to mount a comeback in coming weeks on easing policy uncertainty. UBS expects the S&P 500 to rebound next month as trade policy uncertainty eases. The recent correction, a 10% drop in just 22 days, was unusually fast, driven by tariff concerns and high investor sentiment. UBS analysts believe the Trump administration will clarify trade policies soon, avoiding recession risks. Historically, corrections in bull markets present buying opportunities. S&P 500 gains after a 10% drop average 8% in 3 months, 16% in 6 months, and 19% in a year. Momentum stocks, especially tech, were hit hard, but this has helped reset investor positioning. UBS sees a favorable risk-reward outlook over the next 3 months, noting that bear markets occur roughly every 7 years, with the last one 3 years ago. Clearly, there is some reason to be optimistic, but our big catalyst is Wednesday. That is the Fed meeting, and that could change everything. If the Fed takes the same old approach that the economy is in a good position, they can remain higher for longer and just hold policy where it is, that could actually be a pretty bullish outcome for Wednesday, suggesting that the Fed's not too worried about the economy. In the alternate situation, you could see the Fed turn more towards the dovish side in terms of rate cuts, suggesting more caution on the economy. If the Fed does that, then you get more of that growth concern. And let's be honest, today's data was not good, whether it is New York Empire State Manufacturing that came in -20 versus estimates of +5. Insanely bad. NAHB Housing Market Index came in well worse than expected. Retail sales were revised lower from last month, -1.2% for January, and February's number came in at a measly +0.2%, massively missing expectations of +0.6%. Tariff concerns being cleared up or not does not mitigate the fact that the economy is weakening, and that is going to be the thing that theoretically pushes you into a bear market. It's not tariff uncertainty that will do that. And I also think it's worth keeping in mind that the reciprocal tariffs are kind of a loose language at this point. We have no idea what's on the chopping block for reciprocal tariffs coming April 2nd. And if it's, worse or larger than expected or not as bad as expected, that's also going to be another needle mover for markets. But you could see today's market bounce was really, really low volume driven. So it doesn't seem like there is a lot of conviction with this rally that we are seeing from the lows. Well, the rally we've seen from the lows, okay, you were down about 10% almost exactly. You've rallied about 3.7% from those lows, okay? Most people expect you're going to get a 3 to 5% rally if this is just kind of a dead cat bounce. On the high side, that puts you up to 577. Today, the S&P is at 569.50. So there could be some more upside here. The big test will likely come tomorrow around that 200-day moving average. You're pretty much there now. 200-day moving average at $570.60, and the stock again at 569.50. So you're about $1 away from your key resistance level. If you get rejected around that 200-day moving average, that sets you up for a downside shift yet again. If you break above that, then things look pretty good. That shows more confidence, and likely more traders step into this market and get back leveraged to the upside. Now, the same is true with Tesla in regards to the low volume we have seen recently. There's not a lot of conviction for people to step in and take a long trade here, as long as we have these uncertainties, whether it's tariff uncertainties, growth uncertainties with Tesla, and overall economic uncertainties. Well, I believe it's almost impossible to quantify this more than Google Trends data or some of the weekly data we get out of China's vehicle insurance registrations. But I believe the new Model Y is selling like crazy worldwide. I believe over the next couple of weeks, you are going to see some of those growth concerns, those delivery concerns really start to subside in Tesla. And this is going to open the door for massive opportunity. If UBS is right and markets do recover over the next couple of months, Tesla is likely to recover a lot more. Tesla is likely to have some pretty dramatic upside from here. And with the relatively low volume we have seen, as Tesla has really stalled out after its big drop of 15.5% on March 10th, literally doing nothing, just kind of trading sideways ever since then in a roughly $20 range between $220 on the low side and $240 on the high side. You've just been sideways as volume has started to drop. If volume can come back into Tesla, then that could fuel a large upside move. And I still think even during this bear market bounce, if you will, or dead cat bounce, you could see Tesla around that 200-day moving average, possibly just in a couple of days. And that would be around 285. Tesla stock is at 240 today. That is a $45 potential move higher that I could see coming relatively soon. Here's the deal, whether it's UBS, me, Mizuho, Citi, Goldman Sachs, Bank of America, Morgan Stanley, JP Morgan, no matter who it is, no matter what the analyst is or strategist is, nobody knows what will happen next for markets. So you want to put yourself in a position to win either way, whether you're all in on Tesla, you're in short positions, you're in cash, it doesn't matter. The best way I've found to consistently win in periods of uncertainty is to be positioned for both sides. Take, for an example, how I am positioning my portfolio. I have not sold a single share in Tesla. I refuse to sell a single share in Tesla until I see something dramatically going wrong with Tesla, a bad business decision, bad management decision. I will not be reducing my Tesla position, even if the stock falls to $20 per share, because that's not how I operate. I don't sell unless the company specifically gets worse. We're not seeing any indications of that. The price of Tesla has fallen $240 per share from its all-time high. It's still down 50%, but the actual business has gotten better. That is not something you want to fade. That is something you want to add into. So what I'm doing right now is I'm staying fully vested in this market. I own the same amount of stock now as I did 2 months ago, or 3 months ago, or a month ago, or 2 weeks ago. But I'm not putting new money to work right now, okay? That is where I gain the leverage on this market. If stocks do fall further, or if there is a singular opportunity presented, perhaps that's Apple falling a lot because their Apple Intelligence is a complete flop, or whether that is Tesla that continues to fall, I have dry powder to position into a weaker market. At the same time, I can take advantage of this market if we do move higher. Now, if you are in cash and you're not exposed at all to equities, I think that's a bad decision, as you did just go through a 10% correction. Well, why? Because markets could recover, and you don't want to miss that recovery, but you also don't want to miss the opportunity to put cash to work at better prices. So if you are all in on cash, I do think you want to have some stock exposure, but you don't want to be all in this market. At a moment like this, where the economy looks vulnerable, tariffs are weighing on confidence, and even to a lesser extent, real estate that continues to be bogged down and prices starting to compress, that could put a dampen on broadly consumer spending behaviors, as we've really seen in the last month or two. And the good news is here, this week, you're going to have more clarity on that, because the Fed is such a big driving factor of our markets, and people, take what the Fed says very seriously. If the Fed, leans towards more, they want to get ahead of a potential recession, stocks are going to react to that. Or if the Fed suggests that there's no recession in sight, the risk is inflation, the markets are going to pay attention to that as well. And we do still have some big earnings coming this week, and not as much today or tomorrow. But Wednesday, you have Ollie's in pre-market and General Mills. Wednesday and after hours, you have Five Below. Thursday in pre-market, you have Darden Restaurants and Accenture. And then Thursday and after hours is really the big day. You have Micron, Nike, and FedEx, Nike, Micron, they're all going to be important for their own, respect. Nike, consumer discretionary name by definition. FedEx, transport name, really tell you more about consumer demand. And Micron, important for, again, that AI trade to a lesser extent. Friday pre-market, you have NEO and Carnival that will also be reporting earnings. The CNN Fear and Greed Index today is also moving higher to 22. Yesterday, or Friday, you were at 20, with all of your indicators being in extreme fear, besides market volatility, which is monitoring the VIX and its 50-day moving average that is now neutral, and junk bond demand that is in greed. As I also shared in the last video, percent of stocks trading above their 50-day moving average today up almost 4% to about 31%. So still 69% of stocks are below their 50-day moving average, which overall, again, is pretty damn negative. But again, as I've said in previous videos, we were going to see a bounce, and how, investors tend to operate is when things are just going down, they're going to keep going down and things are going to get worse. When you get a bounce, people think that everything is over, that the reason, we fell was just fear and it's not justified, and we're just going to continue to rally to the upside, which is kind of like what UBS said today in their note out. But it has more to do with tacticals than it has to do with the fundamentals of what drove markets lower. The fundamentals of what drove markets lower: weakening consumer, weakening economy, the Fed still not accommodating things, Trump's tariff policies that are very disruptive as of now. None of that has actually changed. What did happen, though, is markets got oversold and they've bounced. Now the RSI went from 27, almost 26, to 42. Now you've reset the RSI back to a more neutral place, yet you are still down from all-time highs about 8%. What can happen now, it's not guaranteed to happen now, but what can happen now that your RSI reset back to, again, almost neutral, is you could see another wave of selling pressure to move markets lower. But now, instead of falling 10% from all-time highs to get the RSI oversold, now you could fall 12, 13, 14, 15% from all-time highs before the RSI is oversold again and due for another bounce. That is why bear markets tend to happen slowly, because you tend to fall, rally, reset the RSI, fall, rally, reset the RSI, fall, rally, reset the RSI. You've seen that in 2022. So just because stocks are bouncing here does not mean, again, you want to be all in one direction. You do not want to be all short this market. You do not want to be all long this market. You want to be a combination of both. Long this market with cash on the sideline. And if we do actually break above this 200-day moving average, that could be an opportunity to, again, hedge this market, as I do think premiums on the downside will start to kind of relax a little bit if you get above that 200-day moving average. But that is still yet to be seen, as you are below that at the time of recording this video. And I think markets have also relaxed over the past 2 days as you really have not gotten new tariff headlines from Trump. Yes, you got some of that reciprocal tariff headline, but that was not new information. We've known the reciprocals are starting on April 2nd, although we have not really gotten clarity on what those are going to look like. When you guys see these videos and it sounds like I'm bearish or it sounds like I'm really bullish, you must understand that I'm positioned for whatever happens. And I think that's how you need to be positioned as well in a dangerous market like this. I call this market dangerous because the downside, in my view, could be 3 to 4 times the upside. Now, if we get the upside, you don't want to be positioned for the outsized downside that we could see. I mean, always consider markets 50-50. They can go up 50%, 50% chance of them going up, I should say, or 50% chance of them going down. I just view the downside risk is earnings come in weaker than expected via tariffs because companies cannot pass on those costs to consumers because consumers are fed up and over with inflation. How does that work into companies' margins? Do companies take the margin hit, or do they start laying people off to make up the difference in that margin hit? If that is the case, labor markets continue to weaken. The Fed probably starts cutting, but by the time the Fed historically starts cutting, it'll be too late for markets and too late for the economy. And that risk to the downside is large. So you want to be positioned here while also having cash ready to go if things do get worse. Now, I think Tesla's a great way to do that because you've already fallen a lot. You've already priced in a lot of bad news. If things are, not as bad as expected via the deliveries slowdown, which I think in the next coming weeks, we will get positive surprises to that, then I think that's a reason for Tesla to recover from here. If the broader markets, generally speaking, start to recover, Tesla's going to recover a lot more, okay? So there's that avenue as well. But if we did start to slip closer to a recession, Tesla is going to fall quite a bit. You're already down 50%. How much lower do we go? I think only time will tell on that front. But I do think Tesla is going to really outperform to the upside if markets do recover from here. And that's why even if you're all cash right now and you're looking to put some money to work, I think Tesla is the top choice there. They're going to recover a lot more on the upside. They may fall less on the downside. Although if we really did go into a recession, I think everything's going to fall a bit. And that's why you want to keep some cash on the sidelines. In my personal opinion, this is not financial advice. I'm not a financial advisor. Come to your own conclusions. That's just my thought. Now, if you look at option activity today from hedge funds and institutions, you had about 200 different trades totaling $508 million with a positive order value of $42 2%. And if you look at what the short sellers did today, they covered 400,000 shares on net. So you had borrowed shares of 542,000, but return shares of 943,000. So hedge funds and institutions continue to cover on their short positions in Tesla. That is a great sign versus the alternative of more short positions being taken out on Tesla. Now again, tomorrow, besides the GTC conference from NVIDIA and Jensen Huang speaking at 1 p.m., I don't know if we're going to get the comments from the speech coming out beforehand, before 1 p.m., or if it'll be like really from 1 p.m. to 2 p.m. we get all these comments coming out. But I think there's going to be some movers there. Tesla's probably going to be referenced, so that could definitely move Tesla specifically. But you're also going to get building permits, housing starts coming out tomorrow, export prices month over month, import prices month over month, export prices year over year, and month over month as well. So some of that could feed into your GDP report as well. Industrial production month over month, that's expected to fall from last month. Capacity utilization expected to fall a little bit as well. You do also get a 20-year bond auction. So we should get another update from the Atlanta Fed GDP now coming out tomorrow. But via the Fed's blackout period, we won't get an update for the model of how real personal consumption expenditures get kind of translated into GDP. So they came down a lot in the past couple of weeks. That's why your GDP report is negative, but that could be revised up. We will see if we actually have a negative report, but you can see the next GDP Now update is Tuesday, March 18th, which is tomorrow. Now, again, besides that, you have building permits, housing starts. If real estate prices continue to weaken, that's going to put a damper on expected spending by the consumer. As I've said before, 50% of all dollars spent in the economy come from the top 10% of income earners. These are guys that own businesses, that own stocks, that own real estate. As those asset prices start to decline, you've seen that with stocks, you've seen that start with real estate. But if it continues at a larger degree, especially in real estate, you're going to see spending slow down more materially. And that is kind of the catalyst that could theoretically push you into a recession, since markets are so dependent on people spending money. So hopefully this video helps provide a little bit of context what I'm doing in my portfolio right now. Again, staying invested, but holding cash on the sidelines. And some of the risks that are presented here will also some of the positives. It's not all bad, right? We could get clarity on tariffs. That could be good. We could see economic growth start to recover a bit. That could also be good. So let me know what you guys think about this down below in the comment section. Do you think we are getting close to the end of the bear market dead cat bounce, as I think? Or do you believe this is the start of a larger rally that will ultimately take Tesla with it? Let me know your thoughts down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.